Hello everyone. We're here for another video lecture. This time we'll discuss a topic in financial management. Okay, so that will be the valuation concepts and methods. Okay, so our learning objectives, okay, for this video lecture would be we should discuss the capital structure theory, the to evaluate factors that affect optimal capital structure and business and financial risk. Well, business and financial risk will be discussed in the next video lecture. Okay, so optimal capital structure theories. So for this lesson, we actually have three uh, optimal capital structure theories. Okay, so we'll discuss them one by one. But of course, let's talk first, or let's define first, capital. So capital is the aggregation, okay, of items appearing on the left hand side of the balance sheet minus current liabilities except short-term bank loans. Okay? Yeah. So based on our understanding on the basic accounting concept, diba, we have basic accounting equation, we have asset is equal to liabilities plus owner's equity. So itong capital, hindi lang siya actually the owner's equity. Okay? It includes a portion of our liability, particularly the long-term liabilities and short-term bank loans. Okay? So, kasi diba, yung understanding natin when we talk about capital is ano lang siya, the asset minus liabilities. Okay, but in financial management, capital actually includes the long-term liabilities. For example, nagborrow ka sa bank, no, for financing. That is a long-term bank loans, diba? Okay? So that is part of capital actually. When you say capital structure naman is the mix of debt, preferred stock, and ordinary or common equity that the firm uses to finance the firm's asset. So, capital structure, ito na yung mix, no? So, ito na yung mix ng debt and equity mo. So, remember, long-term debt and equity, yun yung nag-finance sa operation, no? Sa business operations or activities. Okay? Ayan. So, now, capital. So, again, the term capital refers to investor supplied funds, okay, debt, okay, preferred shares, ordinary or common equity, and retained earnings. So capital is frequently defined as to include not only long-term debt, that is debt due in more than a year. Okay, so again, sabi natin kanina, aside sa preferred and ordinary shares or aside sa share capital ng entity, part of the capital, no, ng isang business ay yung long-term debt. Again, when you say long-term debt, in yung debt that is due in more than a year. Okay? While capital structure, again, based on the meta language, no, this is actually the mix of debt, okay, preferred stock, and ordinary or common equity. Okay? To finance the entities or the firm's asset. So the financial manager's objective in making capital structure decision is to find the financing mix that maximizes the value of the firm. Diba? The job of or the duty of the financial manager is to what? To add value to the firm and to uh, make its investors, shareholders wealthy, right? Okay, so the job of or to achieve those job, the financial manager should look for the right mix of debt and equity as financing, no, of the firm's asset. Okay? Now, why capital structure changes over time? First is there is deliberate management actions. Okay? So, gusto lang talaga ng management or discretion naman yun ng management. How are they going to mix debt and equity, right? Okay, so capital structure may change because of deliberate management action. The second one is market action. Okay, now for example, a firm could incur high profits or losses that could lead to what? Significant changes on its on the book value of its equity, as shown on its balance sheet, and to a significant change in its stock price. Okay? So, kapag may profit si entity or kapag may loss si entity, it will actually result into what? Into a change, no, of its stock price. Okay? Now, let's proceed to the capital structure theory. So, a capital structure theory, okay, is actually different theories, okay, or differing theories that states what optimal capital structure ba, or what is optimal capital structure ba, what is the right mix of debt and equity as capital of a firm. Okay? Now, can a firm increase shareholder wealth by replacing some of its equity with debt? And if so, how much debt should it use? Okay? So again, the job of the financial manager is what? To properly manage, no, the finances of the firm, and at the same time, uh, increase, no, the wealth or the shareholder wealth or the wealth of its investors. Okay? And by doing so, pwede ba niya gawin na palitan yung kanyang equity, no, meaning palitan yung kanyang preferred and common stocks with debt. Okay? With bank loans. Okay? Or with bonds. Ayan. So, the said question will be answered by the different capital structure theory. Okay? So, we have three, no? In this lecture, we will discuss three capital structure theories, no? The traditional approach, the Franco-Modigliani and Miller approach, and the last one is the contemporary approach. Of course, we'll start with the first one, the traditional approach. Now, the traditional approach to as a capital structure theory, okay, suggests that a firm can lower its weighted average cost of capital and increase its market value by the judicious use of financial leverage. So, ano ba itong tinatawag na weighted average cost of capital? When you say weighted average cost of capital, start tayo sa cost of capital. When you say cost of capital, that's the cost of what? Borrowing money. Or that's the cost of what? Issuing stocks, no? Okay, pag nag-issue tayo ng stock, let's say preferred and common shares to the shareholders, the cost of issuing such stocks would be what? Dividend. Okay? Now, the cost of borrowing money naman from the bank or from the general public through what? The issuance of bonds would be what? Payment of interest. Okay? So, dahil meron tayong mix of debt and equity, then we can actually arrive at the weighted average cost of capital depending on the proportion or the mix, no, of debt and equity as our capital. Okay? Ayan. So, according to traditional approach, we can actually lower, okay, the weighted average cost of capital by what? By utilizing the what? Financial leverage. Meaning, we can lower the cost of capital daw by borrowing money. Okay, so in this case, instead na yung capital mo is just equity, okay, you mix equity daw with what? With debt financing. Okay? So we will realize later bakit ba liliit yung weighted average cost of capital natin when we borrow money, okay, or when we use financial leverage. Now, this theory suggests that there is a trade-off between cheaper debt and higher priced equity that leads to an optimal capital structure. So the cost of capital and the firm's value are not independent of its capital structure. When you say not independent, meaning dependent. Okay? To rephrase that, the cost of capital and the firm's value are dependent of its capital structure. That is what this theory, or the traditional approach, suggests. Okay? So, we will learn more of that later on. Now, the total market value, okay, of the firm can be determined as follows. So, to compute the total market value of the firm, that's value of the firm is equal to market value of debt plus market value of common shares or outstanding or equity. So, yung kinukompute natin dito or yung sinasabi niya dito na market value of common shares ay the ordinary shares. Okay? So, in-include lang niya yung ordinary shares and not preferred shares. Or, value of the firm can be computed as EBIT or earnings before interest and taxes minus multiplied by 1 minus tax. So, basically, this is just earnings before interest, right? Okay? Divided by weighted average cost of capital. Ayan. Now, paano ba natin kunin yung market value of equity? Okay, this one. So that's EBIT or earnings before interest minus interest, earnings before interest and taxes minus interest divided by cost of equity. So that's how you get the market value of equity. While the weighted average cost of capital would be earnings before interest and taxes divided by market value of the firm. Okay? Yeah. So this one right here, the weighted average cost of capital, we will compute, or we will be needing this information right here if the way we computed the value of the firm is in this second solution. That's EBIT, okay, earnings before interest and taxes times 1 minus T. So 1 minus T here is the tax. Okay, so basically you are just getting the earnings before interest and taxes net of tax. Ayan. Okay. So let's take a look at this graph right here. Okay. So this chart shows as the lower cost of debt is substituted for higher cost of equity, the weighted average cost of capital declines to a minimum. So right here, we have here the minimum cost of capital. And in the horizontal line naman, we have the optimal debt value of the firm. Okay? So we have three graphs here. First is the cost of equity. That's K sub S. K sub D is the cost of debt. And K sub E is the weighted average cost of capital. Now, if i-substitute daw natin, no, and when we substitute equity financing, okay, when you substitute that with debt financing, as you can see, nag-increase yung debt here, the weighted average cost of capital actually decreases. Okay? Pero the more na nag-finance tayo ng ating capital through debt, okay, babalik na tataas no yung ating weighted average cost of capital. So, the traditional approach actually suggests na hindi pwede na we finance our capital, or we finance the firm's asset with excessive debt. Okay, kasi although debt would actually make our weighted average cost of capital decrease, or it will decrease our weighted average cost of capital, but to the point that it becomes very excessive, then it will make the weighted average cost of capital rise or increase once again. Okay? Yan. So, dapat moderate lang daw yung paggamit natin ng ating debt. Okay? Now, bakit kaya yung debt natin will actually decrease when we substitute debt for equity ay magdi-decrease, no, or the weighted average cost of capital will decrease. That's because yung interest natin na binabayad sa ating mga utang is actually a tax-deductible expense. Okay, so that's a tax-deductible expense. So when you file for an income tax, let's say for a corporate income tax, di ba, interest expense, okay, is actually a deductible expense for income tax purposes. Okay? Now, another illustration here. So we have here the market value of the firm and the optimal debt value of the firm. So this above chart shows that the market value of the firm first rises. Okay, so tataas. Okay, reaches its peak at point DV. Ayan, itong pinakamataas na point in this graph here is actually the optimal debt value of the firm. Okay? Where the cost of capital is minimized and finally declines as leverage or debt increases. So when you take a look at this chart right here, ito yung point na pinakagamay ang ato ang weighted average cost of capital. So kung pinakagamay itong sa point nga pinakagamay no at its lowest point yung ating cost of capital, that's also the point niya the highest or at its peak yung ating market value ng ating firm. Okay? And as you borrow more money, from debt, no, through debt, then yung weighted average cost of capital will start to increase again and our market value of the firm will start to decline again. Okay? So the traditional approach attributes the cost of debt and equity to changing investor attitude towards risk. Okay, so both cost of debt and cost of equity are almost constant under moderate amounts of debt. Okay? So constant siya at moderate amount of debt. Kaya pero kapag we are getting the debt is getting excessive, we are trying to, or when we increase or when the firm increases its financial leverage by borrowing more money through debt, okay, we can actually see that the weighted average cost of capital will start to increase na naman, and at the same time, the value of the firm will decline or will decrease. Okay? Now, let's try this illustrative case. Yeah. So, i-illustrate natin to. Ayan. Okay, so Brandon's Health Center or BHC has no debt but is considering two plans to add leverage. First is, wala daw siyang utang wala siyang utang. So ito yung current capital structure niya. Okay, na wala siyang utang. So wala siyang cost of debt kasi nga wala man siyang utang. No, wala siyang debt. Yung EBIT niya is 100,000. Okay? Debt and interest, wala kasi nga zero yung debt. Yung current capital structure niya. So the cost, the only capital niya is through what? Through equity financing. And the cost of equity financing is 10%. Okay? Or 0.10 or 10%. Ayan. Now, meron siyang dalawang option. It's either to borrow money by issuing 200,000 peso bonds or to borrow money by issuing 300,000 peso bonds. Okay, so the proceeds from both proposals shall be used to return the same amount of common stock. So management want to evaluate the impact of increasing BHC's financial leverage, data about the corporation's current and proposed capital structure are as follows. Okay, so again, ito na nga, no? So yung current capital structure niya is zero debt, okay, kaya zero cost of debt, and the cost of equity is 10%, 0.10. Now, for Plan A, to borrow 200,000 money, okay, or funds by issuing bonds, okay, worth 200,000, we can see that the cost of debt will now be at 0.07 or 7%. Okay, and the cost of equity will be at 0.105 or 10.5%. Now, when you onto Plan B, wherein 300,000 bonds will be issued, the cost of debt will be at 0.09. So as you can see, when our bonds, when the financial leverage increases or when you borrow more money through debt, tumaas din yung kanyang cost of debt, right? From 0.70 naging 0.09. And the cost of equity nag-increase siya to 0.12. Okay? Now, yung EBIT in all scenarios, no, in the current Plan A and Plan B would be at 200,000 lang. Okay? The debt here is 200,000, and for Plan A, for Plan B, that's 300,000. The interest here for Plan A is 14,000, and for Plan B is 27,000. Now, as you can see, sabi dyan, the proceeds from both proposals, okay, shall be used now to return the same amount of common stock. Pero kung bakit or why is it na when we borrow money and then we return the same amount to, kumbaga we retire stock, okay, And the amount or the money that we use to retire stock is the amount na yung hiniram natin, dapat mugamay ng ano, di ba? Dapat mugamay na yung cost of equity kasi gamay naman atong stocks. Okay, in this case, mas nitaas siya. Why? Kasi nga, nag-demand or mag-demand ang katong mga nabilin ng mga investors. For example, manghiram siya og 200,000 money, no? Through the issuance of bonds. Okay? So, pag meron na siyang 200,000, gamiton to niyang 200,000 para i-retire some of its stocks. Okay? I-retire niya a portion of its stocks. So, the more nga mag-retire siya og stocks, and the more na maghiram siya og kwarta, okay, to retire those stocks, tataas yung cost of equity. Why? Kasi the shareholders will now think that the attitude ba of the investors will now be such a way nga ang risk is nagataas. Ngano nagataas man kasi mas naghiram kag kwarta or using your financial leverage. So mas risky na yung business, and at the same time mag-require na karon si katong mga nabilin nga shareholders of higher return on their investment. Okay? So, di ba, that's isa na siya sa itong discussion on the first part of this subject. Okay? The higher the risk, the higher the return. Okay? Ayan. So, ano ba yung preferable? Okay? Which plan is preferable? Kasi current, plan A, plan B. Sa ilahang tulo, unsa ang preferable? Okay? So, of course, evaluate natin sila. Ayan. Okay? So, this one right here, murag gyapon lang na diri. Now, atong unang buhaton is computing muna natin yung market value of the equity in these three scenarios. The current capital structure, in the capital structure plan A and plan B. So, we'll start with current capital structure. So, the market value of the equity would be EBIT minus, di ba? To compute market value of equity, that's EBIT minus interest divided by cost of equity. So, for current, that's EBIT, 100,000 minus interest. So, zero man yung interest, so minus zero, divided by cost of equity, which is 0.10. Okay, so the market value of equity here is at 1 million. For plan A naman, that's EBIT, 100,000 minus interest na 14,000 divided by cost of equity na 10.5, that's 819,048. Okay? And the last one, for plan B, that's EBIT minus 27,000 na interest divided by 0.12. Okay? That's equal to 608,333 yung market value of equity. Now, after that, computin natin, ito na yung market value of equity right here. Computin natin yung market value of the firm. So, okay, so we would choose between among the three alternatives, so yung current, plan A and plan B, kung sino yung may pinakamalaki na market value of the firm, then you should go for that, or the BHC or Bandon Health Center should go for that investment or plan. Okay? Sige. So, for current, the market value of the firm would be market value of debt, okay, which is in current, that's 0, plus the market value of equity, yung na-compute natin na 1 million. So, 0 plus 1 million, that's 1 million. That's the market value of the firm for current. Ayan. For the current capital structure. For plan A naman, the market value of debt is 200,000 plus, okay, yung market value of the firm in plan A, that's 819,048. That's 119,048. For plan B, that's current, that's the market value of debt, that's 300,000 plus the market value of equity na 608,333. So that's 908,333. Okay? So as you can see, no? Asa sa ilahang tulo ang may pinakamalaking market value of the firm, no? So that would be for plan A. Kasi sa plan A, yung market value of the firm is its highest, or it's the highest. That's 1,019,048. Okay? So this is actually a representation or a representation or a depiction of this graph right here, no? okay, na at some point, when you borrow money to finance your firm's asset or to have more capital, at some point, it will result into the highest market value of the entity or of the firm. Pero kapag excessive na yung pag-borrow mo ng funds, okay, it will result into what? A lower market value of the firm na. Just like here. Okay? So kung makita nato dire, sa 200, sa zero na debt and yung capital is entirely equity, the market value of the firm is 1 million. Pero at the point that we borrowed money, so pag naghiram ng kwarta, the market value at 200,000, okay, na utang, the market value of the firm became 1,019,048. Pero as the debt financing has become or is, becoming excessive, naging 300,000, lumiit yung market value of the firm natin. Okay, naging 908,333 na siya. Okay? So this is a solution or a proof of the traditional approach to capital structure. Okay, so next is we'll discuss the Modigliani and Miller perfect world approach. So when you say perfect world approach, meaning walang risk, di ba? Kasi perfect world. Okay? Yan. So this approach suggests that the firm's value is determined by its real assets, not by securities it issues. So yung value or yung firm's wealth daw is actually determined by yung kung ano talaga yung mga real or physical asset niya. Okay, yung property, plant and equipment, inventory, yun daw yung basis of the firm's wealth rather than yung securities na inisyu na either debt or equity securities. So thus capital structure is irrelevant and all capital structures are equally desirable. Okay, so dahil the capital structure here is not the basis of the firm's value, so lahat daw ng klase ng capital structure is just what? Pwede siyang desirable siya and irrelevant siya kung i-compare pa natin, di ba? So the theory assumes no taxes, perfect world. Walang tax, di ba? Walang chance of bankruptcy and no brokerage costs. Investors can borrow at the same rate as corporations. Okay? EBIT is not affected by the use of debt perfectly efficient markets. Symmetric information sets for all participants. When you say symmetric information, lahat ng value ng information ay natatanggap ng lahat ng investors. Okay, so kung mapa-wealthy investor ka man, or mapa-middle class investor ka man, or mapa-corporate investor ka man, lahat ng information na natatanggap nyo before you invest is the same or of the same value. Okay, that's symmetric information. Okay? So, sa kanila lang, we can really say na this is not what's happening in the real world. Kasi, meron naman talagang tax in reality. Meron naman talagang chance of bankruptcy. Okay? Meron naman talagang brokerage cost when you issue securities, when you issue equity securities, and when you issue debt securities, meron naman talagang brokerage costs. Okay? Ayan. So, anyway, we can actually use this theory para malaman kung ano talaga yung effect, no? Kung ano ba talaga yung effect ng, ng taxes, ng bankruptcy, and ng brokerage costs, and all other factors affecting the firm's wealth. Ano ba talaga yung effect nila? Okay, so, kumbaga, this approach, it may not be ideal, in real world, pero it could be, it could be a great avenue in building a capital structure theory that's best suited sa real world talaga. Okay? Ayan. So, in figure 3 and 4, the Modigliani and Miller approach to capital structure without corporate taxes. So, wala tong corporate tax, ha? So, meron tayong cost of equity, meron tayong cost of debt, and then tayong average cost of capital. As you can see, when the cost of when the cost of shares increases and when the cost of debt increases, the weighted average cost of capital is just the same. Okay? Ayan. Okay, so it shows no dito sa ating figure 3 na uh, as the cost, okay, as the cost of equity increases, okay, there should be an enough amount, okay, of debt so that the weighted average cost of capital will just stay the same. Okay? And kung makita natin dito sa ating figure 4, okay, sa figure 4, we can see that regardless of the, the mix, okay, or the proportion of debt to equity, the weighted average, the value of the firm is actually independent. So, independence of the financial leverage. Why? Kasi nga, kung makita natin, di ba, sa traditional approach, as we borrow money, okay, as we move into debt financing, as a mix of capital financing or equity financing, yung value of the firm natin is nag-increase up until its peak. Okay? And then, pag nasa peak na siya, and then you still borrow money, okay? Mugamay na ang value of the firm. However, in the Modigliani-Miller perfect world approach na walang without corporate taxes, the value of the firm is independent. Okay, no matter independent with the the debt and equity structure. Okay, no matter how much is the debt or how much is the amount of equity, it will not affect, okay, our value of the firm. Okay, now how about when we consider kanina yung Modigliani and Miller perfect world approach natin is we did not consider corporate tax. Okay, now the second approach to capital structure with corporate taxes, this model shows that the use of financial leverage lowers a firm's cost of capital and raises the firm's value because interest on debt is tax deductible. So in this case, sa Modigliani and Miller approach to capital structure, gumamit siya or consider niya yung corporate tax, which is actually what's true in the reality, di ba? Kasi di ba meron naman talagang corporate taxes, and when you borrow money, you pay interest. Interest is an expense, and that expense is tax deductible. Okay? So, in this model, the use of financial leverage lowers a firm's cost of capital. Thus, in the world of corporate income taxes, there is a substantial advantage when debt is used. Kasi yung binabayad mo na interest sa yung mga debtors, 'di ba? O sa yung creditors, yung pinaghirman ng pera, 'di ba, to finance the firm's asset. For example, when you borrow money from the bank or from any or other financial institutions, when you pay interest, that's an expense, and when you file income tax, the said expense is tax deductible. So because it is tax deductible, it will decrease your income tax. So meaning that is what? A good financial leverage considering corporate taxes. Okay? Pero yung dividend na binabayad mo sa yung mga shareholders, that is not an expense, right? That will only decrease your retained earnings, but it will not be a tax deductible expense when at the end of the year, you come to file your income taxes. Okay, so mas may financial leverage when you borrow debt, again, kasi nga the interest that you pay to your debt is tax deductible, kesa sa when you issue equity and then you pay dividends, and dividends is not a tax deductible expense because in the first place, it is not an expense. Okay? So the value of an unlevered firm with taxes is determined as follows. So when you say unlevered firm, that's value of an unlevered firm with corporate taxes, that's EBIT Okay? EBIT 1 minus T divided by cost of equity of an unlevered firm. When you say unlevered firm, ito yung firm na walang debt. Lahat ng capital niya is what? Equity financed. Now, while the market value naman of a levered firm with the corporate taxes is determined as follows. So that's value of a levered firm with corporate taxes is equals to kung ano yung nakuha natin kanina sa value of an unlevered firm, i-add lang natin yung present value of the interest tax shield. So, ano ba itong interest tax shield? Yung interest tax shield is ito yung uh, tax or ito yung portion ng interest na binabayad natin that can be what? Deductible for what? Income tax purposes. Okay? So, ayan, so we have here no figure 5 and figure 6 presents the Modigliani and Miller approach to capital structure with corporate tax. Okay? Now, sa figure 5, ayan, sa figure 5, we have there the cost of shares or cost of equity. And dito naman, we have the cost of debt. Okay? Yung cost of debt natin is net of tax. So, yung net of tax natin, meaning yung tax savings natin, yun yung interest tax shield. So, kaya as we can see, the weighted average cost of capital nag-decrease siya as we borrow more money, no? As we borrow more money, the weighted average cost of capital will actually decrease. Okay? Now, if the cost of debt is net of tax, when we consider corporate tax, is unaffected by financial leverage, then the weighted average cost of capital declines as the firm borrows more. So when you borrow more money and you pay more interest, yung cost of capital mo will also decrease because, again, of the tax shield. Now, in figure 6, it indicates that the value is maximized with virtually 100% debt financing. This result is consistent with the assumptions, but it is not observed in practice. Okay? So kung makita natin, itong VU, ito yung value of an unlevered firm. Okay? So ito naman yung value of a levered firm wherein kinonsider niya yung interest tax shield or present value of tax shield. Okay? So sabi niya, kung yung firm mo ay when we consider the market value of the firm with corporate taxes pero si firm walang financial leverage, meaning wala siyang utang, lahat ng kanyang capital is equity financed, it's the market value of the firm will only stay here. Okay? Will only stay here. Pero when you borrow money na to finance the firm's asset, or when you borrow money para pang-capital ng firm, then the market value of the levered firm in this case will now increase again because of the present value of the interest tax shield. Again, because the interest that we pay to debt, no, yung interest na binabayad sa utang is tax deductible. Okay? Now, the third theory or the third capital structure theory, which is would be the contemporary approach or the trade-off theory. So the contemporary approach to capital structure asserts that there is an optimal capital structure or at least an optimal range of structures for every firm. So this approach identifies several factors that can lead to an optimal capital structure for a given firm, such as, no? So itong sa contemporary approach, kinonsider niya not just the effects of tax, but also the financial distress, no, and other related costs. Isa pa, yung tax effects is both corporate and personal, plus financial distress and related costs. Okay? So corporate income tax, no, the use of debt in the capital structure of a corporation reduces its cost of raising capital because interest on debt is tax deductible. So it shares the same concept, diba, with the Modigliani-Miller capital structure approach or approach to capital structure considering corporate income taxes. Okay, so ganun din dito sa contemporary approach. Kaya lang, aside sa corporate income tax, it also considers no financial distress and other related costs. So the contemporary approach allows for the possibility that the firm may go bankrupt. Okay, kinonsider niyo yun. So this implies that the firm's debt holders will have to allow for the possibility that they might not receive everything that they have been promised. So in this move, okay, kasi nga kinonsider niya other, other instances na it may make the investment of its investors risky, then they ayan, so in this move, no realistic type of situation, because of that, no bondholders will be what? Will be asked, okay, to bear some firm risk, and therefore, in turn, will ask for a little more return. So again, kasi nga in this, in this approach to capital structure, kinonsider not just corporate income tax, but also yung mga events that makes the investment of its investors risky. So the bondholders, okay, in this case, or the shareholders in this case, will also ask for a higher return on their investments. Okay? So risk and return. Yeah. So as you can see, we have here the value of the firm with zero debt. So ganito lang yan, no? Zero debt meaning lahat ng kanyang capital is equity financed. So ito yung value niya at the straight line. Pero ito naman yung value of the firm, okay? Ito naman yung value added by debt tax shelter benefits. So ito naman yung value ng firm kapag aside sa kanyang equity financing, meron din siyang debt financing, nag-i-increase yung value of the firm because of the tax shield. Okay? When you borrow money. The tax shield doon sa kanyang interest, no, in its debt financing. Okay? Yeah. Again and again, yung tax shield dito, it increases the value of the firm. Okay? Kasi nga, yung interest na pambayad sa utang is tax deductible, just like in this graph right here. Okay? When you borrow money, the tax shield that the debt financing provides to the firm, no, will actually help to increase, no, the value of the firm. But of course, because in the contemporary approach, we do not just consider the corporate income tax. Okay, we also consider other factors, okay, that may affect the market value of the firm, such as financial distress, no? The possibility that the entity may go bankrupt. Okay, or okay, so because of those other factors, no, financial distress and other related costs, nag-decline yung market. Kung ang i-consider lang is yung corporate income tax, and corporate income tax, when you borrow money, magtaas gid ang value ng firm or market value of the firm. Pero kung i-consider na under the contemporary approach, nag-consider na yung possibility of a financial distress and other cost, so mag-decrease na siya. The more nga nanghiram kag the more nga nanghiram ka og nanghiram kag kwarta, okay, it may increase the value of the firm, pero at some point it will start to decline, no? It will the value of the firm will start to decline because kung mas daghan nagataas imuhang imuhang debt financing, no, imuhang long-term liabilities, it will it will result into a higher possibility of bankruptcy, baka dili na mabayaran ang interest, di ba? Or basig ang mahitabo kay dili na ma-recover sa mga bondholders or sa imuhang mga creditors ang ilahang investment. Okay? Ayan. So ito yung value reduced by bankruptcy related cost. Ayan. And then we have here also the actual, the actual price of stock. Okay, so nag-increase. Okay? Ayan. Okay, so in D1, we have here the threshold debt level where bankruptcy cost, okay, becomes material. So the bankruptcy cost becomes material. While in D2 naman is the optimal capital structure. So where the marginal tax shelter benefit is equal to the marginal bankruptcy related cost. So ito na 'yon, no? Dire, okay, kung asa sila last kung asa sila last nagdikit, no, itong dalawang graph na to. In excess of that, okay, considering again bankruptcy related cost, umihinay na decrease, okay, ang market value of the firm. Yeah. So that's the contemporary approach trade-off theory. Okay? So trade-off theory of leverage states that firms trade off the tax benefit, okay, of debt financing against problems caused by potential bankruptcy. So with the theory, the optimal debt level exists at which point the marginal benefit and financial leverage equals the marginal cost. So the marginal benefit, no, of the financial leverage at this point in D2 is now equal to the marginal cost of what? The marginal cost of possible bankruptcy. Okay? Ayan. So, so the value of the levered firm, considering tax effects, financial distress, and related costs, could be determined as follows. So ito na yung value of the levered firm under the contemporary approach, trade-off theory, no. So the value of the levered firm with taxes, financial distress, and related cost is equal to value of the levered firm with taxes plus the present value of net tax savings minus the present value of financial distress and related cost. So parang dinagdagan lang niya yung dito sa ano kanina, 'di ba? Sa Modigliani-Miller approach to capital structure with corporate taxes. 'Di ba? Kinumpute natin yung value of the levered firm with corporate taxes. In the contemporary approach, dinagdagan lang niya yung approach ng present value, okay, deduction ng present value of what? Present value of financial distress and other related costs in computing or determining the market value of the firm. Okay? So another figures here, you have figure 8 and figure 9, shows the contemporary approach to capital structure with taxes, okay, financial distress, and related cost. So in figure 8, okay, it shows that the weighted average cost of capital declines because of the favorable net tax treatment given to debt. So mag-decrease siya, no? When you borrow more money, again, it will decrease the weighted average cost of capital because of the tax effect or the tax shield. And then at relatively high degrees of financial leverage, so the more that you borrow money, okay, because of high ayan. So, and then at relatively high degrees of financial leverage, because of high bankruptcy cost and related costs. So, tataas ang ating weighted average cost of capital. Okay? So, again, because of financial leverage, because of the tax shield provided for by financial leverage, liliit yung ating weighted average cost of capital. Pero pag naging excessive na yung financial leverage natin, naging excessive na yung hinihiram natin na fund, the weighted average cost of capital will now start to increase. Again, because of, kasi when you borrow excessive funds na, then it will pose what? The threat of bankruptcy cost and other related costs. And in figure 9, it shows that the value of the firm with taxes, financial distress, and related costs. So at this point, no, at this point here, okay, together with the point here, kung asa ni nga point mas pinakagamay sa weighted average cost of capital, the market value of the firm will also be at its peak or highest. Pero the more nga manghiram kag kwarta or mag-increase yung financial leverage mo, there will now be an increasing threat of bankruptcy cost and related cost. So tataas yung ating yung ating weighted average cost of capital. That's why the market value of the firm will also start to what? Decline. Okay? So actually, the Modigliani-Miller model also assumes perfect capital market, okay, which implies no transaction cost and rational investor behavior. Again, this is not what's in the reality. So this set of assumption holds constant all influences on firm value and cost of capital other than capital structure. So this restrictive assumption reduces the realism of the traditional and Modigliani-Miller approach, but it provides a starting point for understanding the theory of capital structure. So hindi man sila yung favorable na gamitin in the market, pero they set the stage. Okay, for what? For a wider, wider scale of understanding of, the theory of capital structure. So the contemporary approach relaxes some of these simplifying assumptions. How? Of course, uh, by considering corporate taxes. Ano pa? By considering financial distress. Kasi the more you borrow funds, the higher the threat of, the higher the threat niya baka maging bankrupt because interest cannot be, can no longer be paid, or there will now be default risks, okay, and all other costs. Okay? So again, yung MM or the Modigliani-Miller and traditional approach, they may not be what's very useful in reality, but of course, again, they set the stage for a wider scale of understanding, okay, the theory of capital structure. Okay, so in our next video lecture, we will discuss the factors that influence optimal capital structure as well as business and financial risk.